Well, you do know J-Pow's infamous last words, don't you? Well, we've got a nasty bearish engulfer that certainly lives up to that standard and a failed bullish reversal from Tuesday's session that we need to talk about in today's episode of the Midweek Market Update. As always, we'll be building a game plan based on logic to determine what we should do next for the remainder of this week. Check out the links listed down below in the description, hit the thumbs up button, and subscribe before we get started here, and stick around until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's kick things off here on our SPY daily time frame chart, shall we? What's going on from a trend perspective? Certainly stronger odds now for a weekly, not daily, but weekly lower high to hold from here to here, now that we're spending more time and we have a more definitive breakdown of the breaking point, as we dubbed it from the video 2 weeks ago, at 445. And clearly, the bearish engulfer on today's session is quite nasty, firmly supplanting us underneath that level. From a daily trend perspective, though, we know that this was the threat for a daily lower high. We were sitting on equal lows headed into the Monday session, and we've certainly produced a lower low, meaning that yes, we are now in a daily downtrend with the production of our lower low. So is it reasonable that we could look for a counter trend move to set a lower high and then continuation in the downward direction? Absolutely. And one of the things we'll see on the hourly chart in just a moment is that it's going to be fairly difficult to be short in the hole, so to speak, quote unquote, short in the hole at the bottom of this move, especially as we head towards the lower bound of this week's expected move. It's not that the market can't move lower, but we need to make sure that we're positioning ourselves with solid risk reward. The other thing that I want to point out here before we move on down to the hourly time frame chart is that if you strike a trend line that looks something like this, you can clearly see, and we talked about this in the Saturday update, that the range compression has started to break in the downward direction, definitively more bearish than bullish. So as of right now, the data points are stacking up on the daily time frame chart for a bearish move or bearish continuation, obviously in the downward direction here. The other thing to point out on the daily before we move to the hourly is that if this was a balance range, as we know Thursday, Friday of last week was pretty nasty on a fake break, which turned into a look above and fail, and we always target the bottom end of the balance. Well, on this morning's session, we technically had from Tuesday a bullish reversal off the low of day, and this morning we were gapping back up into the range. So could it not have turned into a look below and fail, retarget the top end of the range? Obviously, it could have done that, and there was a very minor gap fill reversal ahead of the FOMC, but certainly no strong buy-side reaction to that open up and over 443.25. So that would be a slight indication that nobody really wanted to buy this market ahead of the FOMC risk, and thus, obviously we moved lower with a lack of buyers. Sellers kind of take over, fuel on the fire is the FOMC, and of course we close out this bearish engulfer. So overall, daily time frame chart is making a little bit more sense for a move in the downward direction or continuation in the downward direction. Let's move on down to the hourly chart here and really dissect the price action. So again, on Tuesday you can clearly see this strong reversal back up towards the bottom of the balance. This is the balance we were just discussing on the daily time frame chart. This morning's gap up, even in the lower wick of the first hourly bar, if I really zoom in tight on this, you can see that lower wick does offer a little bit of a gap fill reversal, and there's some consolidation ahead. It's really only the FOMC announcement in here that sends markets aggressively lower. So buyers were not really doing what we wanted them to do with the gap fill reversal, making a move back up and over the opening print for a rotation up towards the top of the range that would have completed the look below and fail, right? So it's fair to say that the buyers did not really show up. They continue to show a lackluster display of response around this 445 zone, and I think that this morning's session is another kind of example of that. Full transparency, right? Obviously, with this hammer from the prior day session gapping up and over it, I was looking for the long up here, absolutely. It's just that the buyers never actually got in gear. We never even made the move up to 445. We never even attempted a higher low over that level. So I think that the chart speaks for itself, and obviously we closed weak. So that does set up the continuation move in the downward direction. Buyers had their one last saving grace this morning, and that ship has sailed ultimately. So what are we looking for going forward? I mean, we basically closed weak at the lows. Sellers do remain in control here. There's not much to read into from a psychological perspective with today's daily bar close, obviously. So yeah, again, bears really remain in control. If we throw on our Fibonacci's here and the anchored view apps just to provide a little bit of confluence at some of these levels, I think that it's very difficult for a bullish edge to be rebuilt in this market after today's damage unless we can get some sort of clear higher low up and over 443.25. And even then, you can see that our anchored view app band is going to be barreling down on us. As long as we're underneath that, the bears do have the upper hand. hand, right? And we can also provide confluence with our Fibonacci's coming in from the low to the high of the most recent move. Notice that we've slashed right through our 61.8, which is classically what we're always looking for as a last line in the sand from a fib perspective. So bears do have the upper hand as long as we're underneath that 61.8, which is confluence with our 440.50 level. We'll talk about that in just a moment here, but one last Fibonacci perspective from the top now down to the bottom. Notice that your 38.2, which is classically a line in the sand for healthy consolidation, be it bull flag or bear flag, but this keeps bear flag on the table as long as we're underneath that 38.2, and it's kind of right in that magic zone. It was today's high of day, basically around 440, 440. So all things considered, the bears do have the upper hand no matter how you slice the cake here on the hourly time frame chart, daily time frame chart, with the loss of a neutral daily trend flipping back down into a daily downtrend. Obviously, this is an hourly downtrend here, and again, we have a very weak close at the lows. So what does that leave us with for a path into the remainder of this week? As we pointed out on the daily time frame chart, it's going to be fairly difficult to be short at this stage in the game right on the lows. We'll talk about spike rules on the market profile in just a moment, which will help us navigate this. But if we're just opening down here or even on a minor gap down tomorrow, I don't really think that you have decent risk reward until the market rallies first to produce a lower high. Ideally, it's underneath that 440.50. Remember that we had confluence with the 61.8 Fibonacci from low up to the high. Producing a lower high here offers great risk reward for a short. You're entering here, stop goes over the top, and then you're looking for a retest of the equal low and then follow through in the downward direction. The bears still have the upper hand. Even if we make a rally attempt that does something that looks like this, I wouldn't want to see any price acceptance over that 443.25. However, you could actually trade this on the bull side of the market as a scalp. Let me be very clear here that this is a scalp, nothing more and really nothing less, right? If you can get some sort of higher low over 440.50, then it's a scalp long only into 443.25, right? Because you can go entry here, stop here, target up there. That's easily offering a 3-to-1. But we're not we're not overstaying our welcome on the back test of where the breakdown ultimately came from at 443.25. That would really be where you're looking for your daily lower high, right? So then the next stage of the sequence would be a move lower off of that. If we do just get straight up continuation in the downward direction, I would sort of step aside and let the market continue to move lower and see if we can find buyers at 436. Again, just chasing it short on a gap down open gets very difficult, especially for my own personal risk tolerance. Therefore, I couldn't really recommend it to anybody else. So chasing the short in the hole here, to me, seems like a risk. I would want to see some sort of interaction at 436 that either bounces for a very minor lower high intraday, something underneath a descending VWAP. You could participate in that fashion. Then the next big downside target, this is where things get real dangerous on the higher time frames. 432. Can you believe that? 432 would be the next big downside target if we do see a slip of 436. So that's really what I'm seeing as a roadmap going forward here. We have plenty of confluence with the levels. I think that basically everything we've looked at here from an anchored VWAP perspective, Fibonacci perspective, psychology perspective, the lack of follow through on the gap and hold this morning, at least ahead of FOMC, speaks to the buyers not really showing up, and therefore the sellers appear to have the edge. Market internals are always Exhibit A for supporting evidence. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's focus on the open from today's session because it's very important to understand here. We open on the bull side of breadth. The advanced decline line is climbing into trend higher zone, and the ticks open up well above positive 1,000. And remember, all of this is happening in the context of a gap up. So a gap fill reversal under these circumstances with the internals remaining very bullish on the open should have yielded some sort of gap fill reversal. When that doesn't take place, it's a pretty big clue that, hey, the buyers aren't really showing up here to do their job, even on bullish internals. Maybe step aside. And of course, FOMC is the volatility that kind of kicks off the downside in the first place. However, let's actually maximize our ES futures. One of the concepts we talked about in the pre-market live stream was that the stronger downside would come in when we start to punish the buyers from the afternoon consolidation of Tuesday's reversal, right? This squeeze in the first place punishes the shorts from the lows when and if we could have broken down underneath the overnight low, which was confluence with the consolidation from Tuesday afternoon. That's when your stronger downside was going to come in. And lo and behold, when we slip that, when Jerome Powell starts speaking on the mic, of course, that's where the pain really sets in. So the buyers were punished. They were unable to really hold prices in an ideal location, which would have been over the prior high of day and our main inflection point at 44.95 that we've been talking about, even with bullish internals. So even, again, just put yourself in the shoes of a buyer. If you're seeing everything that you want to see, all the bullish internals are aligning with the upward thesis, for it to not materialize, once again, has to be fairly disheartening to a lot of buyers out there. So if they continue to step aside from this market, it certainly seems as though, again, the bears are building the upper hand. What do we want to see here in the futures? Any back tests of roughly 44.68 do produce that lower high. That would be the equivalent, if we just jump back on over to our SPY, that would be the equivalent to our 440.50 rejection. And I also want to show you over here our breadths on the market internals. If we open this up, they were actually deteriorating. So as the day continues to wear on, as the consolidation really sets in, you can see the morning, first hour and a half or so of the day is fairly neutral. The remaining elevated breadths are somewhere in the neighborhood of roughly 4.34, 4.35 to 1 positive. They start to drift lower as we head into FOMC. Remember, that's 2 o'clock here. So again, the waning breadth as we're getting that consolidation, as we're continuing to get those lower highs and just nothing really going on here off of the gap fill reversal attempt out of what was originally very bullish internals, especially if we think back to what the tick did on the open here to the zero line, neutralized back up towards, positive 800, was looking fairly good for upside. Again, to see that not get follow through in the upward direction really gives credence to the upper hand that the bears have ultimately built. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, what's going on with value area and point of control on today's session in relationship to the Tuesday session. Ironically enough, value is overlapping to up, and the point of control did close at the highs of today's session instead of down at the lows. And I think that this is fairly straightforward. Obviously, all of the time was spent consolidating before the FOMC, and when the FOMC happens, it's an aggressive momentum style breakdown, so there's not a whole lot of time or volume committed at every single price. So I think that this can be a little bit misleading here, and what we want to focus on for tomorrow morning's open are really the spike rules. And a spike is when we have something into the close where the buying or selling pressure only stops because the market ultimately closes. So M period here produces a downside spike. The selling pressure only stops because the market closes at 4 p.m. We don't know whether or not these prices are fair, whether or not we will build out value down here. So the spike rules would tell us if we open underneath the bottom of the spike, we are looking for the market to continue to auction lower, to look for buyers to step up at some lower price. In this case, our next downside support in the ES is closer to 44.20. If we open inside the spike, we're looking for responsive trade and to learn something at the top of the spike here. That's at 44.64, or at the bottom of the spike at the prior low of day. That's today's low of day, which I'll give you the number here is 44.45. That's if we open in the spike. If we open above the spike up here north of 44.65, that basically tells us that these spike prices are being rejected, and these shorts should get squeezed on the open. Now, as of right now, you can clearly see the orange last traded prices underneath, giving us the intent for a gap down on tomorrow morning's open, but there's a lot of time between now and 9:30. If we open up over the top of the spike, once again, that level is 44.64, you better believe these shorts will be in a world of hurt who initiated in the spike and got caught at the bottom of the move if we're opening up here. The intended idea would be for a squeeze, and the next big target would be half back on today's session, right around 44.75. So that would lead to a little bit of an upside move. The other interesting thing about this spike is that the closure, or the top of the spike, I should say, is actually the value area low from Tuesday's session, giving us a mechanical level here at that 44.64. And this level is the equivalent as well as your ES, well, obviously we know 44.64, but your S&P 440.50, right? So in a picture perfect world, the sellers produce some sort of lower high underneath. If we get the higher low above, not only are we negating the spike prices from down here, but we're getting the higher low above structure, and we'll look for the upward rotation. Once again, half back becomes the first target, then we can walk up the targets that we discussed on the hourly ES. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that it's a bloodbath out there. There's full-blown correlation to the downside, which is exactly what you need if you're going to get a nasty move in the market overall. Remember that when these sectors are mixed, you usually get much more so of a rotation and something similar to like what we saw in the midpoint of last week. So as of right now, it is making sense that the market is lower here. There's no major divergences to really point out. At the top of the list, it's the XLV for the healthcare sector, second heaviest weight by market cap. As we know, it's also D for defensive. That's only down 0.22% at the top of the list by being down the least, right? At the bottom of the barrel, it's the XLY for the consumer discretionary sector, down 2.29% on the week. This is definitely a heavier weight risk on style sector, so not great seeing that floored at the bottom. I will concede that the XLK is sort of more centralized. It's not even down 1% on the week, but the structural chart is the big concern. Speaking of, let's take a look through those now. Here's the XLV for the healthcare sector. As as you can see, it is in a downtrend with daily lower highs being produced and obviously daily lower lows as well. So could this be your next lower high from here to here and then continue the trend lower? Absolutely. That would continue to put bearish pressure on the S&P as a whole, but as long as it's not making an aggressive new lower low underneath, as we've talked about in the past, this level right here, 130.25, it can't really be all that bad from a structural perspective. Things really start to change if we get lower highs in this area for a larger weekly breakdown of an overall balance range, right? That is the larger threat here. XLF is also producing a little bit of a threat. Of course, this continues to feel like an opportunity at some point for a weekly lower high, the more that we just kind of struggle to keep this daily uptrend alive. Because remember, we have low, higher low, still an attempt for a higher low. Like, I'll always give credit where credit is due. However, bearish engulfer closing underneath a hammer low after taking out the hammer high and seeing a morning rally. Couldn't even make it to the equal high on the daily. Again, it seems to me that there's definitely more of a bearish edge here. And if anything, this starts to feel like maybe daily lower high, and all we kind of need is an equal low down here, and the trend is back to neutral on financials. So certainly not helpful to the bull case. If anything, sort of providing more evidence actually for the bear case with the close underneath the hammer low from Tuesday. Let's take a look at the XLP, what's going on with consumer staples. Lighter weight, D for defensive sector. Lower highs continue to be enforced on the daily time frame chart, trying to resolve these lows around 71. Just as a reminder, there's kind of a nasty range to trade for underneath us if we break that down to 69.50. And, you know, although yes, this is D for defensive, let's not forget, if we're breaking down to big time weekly or monthly lower lows, that's a big deal, even if it's a defensive sector, right? At some point, downside pressure is just simply downside pressure for the S&P. It doesn't matter if you are a defensive or risk-on style sector. So overall, under 71 gets fairly dangerous here, and it does look like the break could be coming sooner rather than later, with the inverted hammer producing a lower high once again against the backtest of that 72 level. Next up, XLU for utilities. The main threat here, remember that this is a D for defensive risk off posture style sector. Remember that this outperformance was the leading red flag. Now that we're pulling back, is it going to produce a higher low up and over 63.75? And if so, holding this here above the top of the prior balance to produce some sort of like daily reversal back up to the 65, if that's all we get as the market tries to find a quote dead cat bounce or counter trend move on the SPY hourly or something like that, if utilities lead that charge to the upside, that's going to be a daily lower high and hourly lower high on the SPY that we want to look to short into, not necessarily have confidence in for a full-blown daily reversal. It's like, again, this would be if we're being led by the XLU as a sector exclusively. XLI, what's going on with industrials? Breaking down here, lower high rejection in today's upper wick on the backtest of 105.35. Everything about this looks like deterioration, downtrend in force, right? Lower highs, lower lows. XLK. This is where, again, there's definitely some damage being done with the failure to hold on to this level right here. We talked about it in the weekend update from Saturday. With the close under 170.25, we either needed a miracle early on in the week to get back above with a higher low, and here would have been more neutral. Underneath was definitively more bearish. With today's bearish engulfer, once again, closing underneath a hammer low, even after a very, very minor, but technically their gap up, it, to me, speaks more bearish than bullish at this point in time. We're either going to get further consolidation in here, which just at this point, anything sub 170.25 is bearish consolidation, right, in this trend sequence, or follow through to the downside is 163.25, further downside pressure. If we do rally off of these lows, again, this is bearish consolidation. The only time to be like, okay, we're back to neutral is on a higher low over 170.25, which after today's daily structure seems like a little bit of a stretch. Next up, XLC for communications. Not as bad over here, but we did break down and fail to hold on to the neckline of the original double bottom from back here. It's crazy how that feels like it was so long ago already, but with the close underneath 66.75, it does open up the door for some more sell side pressure, downward bearish pressure for our S&P as a whole. Here's real estate. I would have expected real estate to be more aggressively lower on today's session because of the SEP and the higher for longer that we're about to discuss in just a moment. But if we're inside of the range, it's kind of neutral. If it does break down underneath 35.80, that would definitively be more bearish pressure for the S&P. But remember, really lightweight sector. Same thing here with the XLB. Extremely lightweight sector. However, breaking down underneath this 80.25, producing a weekly lower low after some sort of weekly H pattern. There's your weekly lower high, right? It's pretty difficult to have confidence in this as a neutral chart. It's definitively flipping more bearish the more time that passes underneath 80.25. Next up, we've got the XLE for the energy sector, finally producing what might appear to be a red week, but again, it's a bloodbath out there. It's kind of like there's no escaping the sell side. So if this consolidation breaks, if we fail 90, there is a very minor gap to close to the high of the hammer in here, but overall a weekly not daily, but weekly higher low could be produced at our 50 SMA, keeping this uptrend intact. Of course, the threat would be a lower high rejection on a daily afterwards starts to neutralize the trend, and then maybe we set up some sort of head and shoulder, so on and so forth. But as of right now, even if we do pull back, energy could catch itself for a higher low and maintain this overall trend. In terms of sector leadership, this wouldn't really speak to an overly risk-on sentiment out there. Last but certainly not least is the XLY. What's going on with discretionary, where the most damage has been done, down 2.29%. You can see that we failed our daily 50 SMA. We're right back down at this low, which ironically is the double bottom neckline from back here. So that has not failed yet, but clearly there's an opportunity now that we have certainly broken under that 50, 170.25. Ironic also that it's the same level over in the XLK, right? But now that we're definitively underneath that level, this is now bearish consolidation, right? This was kind of keeping us neutral. We were hoping for a higher low up here. That might have been a little bit more helpful for the bull case, but this was still neutral. This is bearish consolidation. It doesn't change as long as we're under 170.25. So based on how we've evaluated the sectors so far, again, I do think that there's a little bit of a more bearish edge building out there across the broad market. Here's the sector ratio grid as just a different way to visualize relative strength and weakness. If you're not familiar with how to set this one up, check out the tutorial in the top right-hand corner. I think it's pretty fair to say that the risk on revival is coming to an end with the XLK fading back off underneath our now descending 50 SMA. That's the gold moving average. The XLV is perking up over its flat 50 SMA. This is D for defensive, as we know, right? XLF, decent performance here, equal highs on the table. I'll give credit where credit is due, so that's helping, but it's certainly not as heavyweight as our XLK or the XLY in terms of risk on posture, at least. Notice the sharp reversal, unable to produce a higher high. From here to here, yes, higher high, but weekly lower high is on the table from this area down to this area. We're still above the 50 SMA. It is kind of starting to show some rollover here. I'd be more neutral on this than anything else. So once again, the revival attempt that we had here, driven from the tech sector, it's faded off. This is not really helping as much as we want it to, and it looks like defensives and the risk off posture is starting to creep in, mainly in the XLU, attempting to produce a higher low over a descending 50 SMA. Notice that we have not been above the descending 50 SMA in a very, very long time here. So this is definitely a change in tone that is worth being aware of, at least that the risk off posture is coming into this market. We could look at some specialized ratios like XLK over the XLU. Notice that we're back down at the equal lows. So this, as a higher high, did not produce a higher low. Sitting on the equal lows, if it breaks, we're expecting a trend reversal after a failed higher high, basically, right? So that would speak to risk off positioning entering the market here. And if we take a look at the XLY over the XLP, this is a little bit better, but definitively pulling back from that high. I mean, there's no arguing with that yes, we did produce technically a higher high. There's still an opportunity over an upward sloping 50 SMA, but this is, again, one ratio that we're looking at in a sea of all the other ratios that would sort of point to, at best, neutrality, if not a little bit more of the risk off cohort creeping into this market. How about our good friend the dollar? You can certainly see that it's getting bullish consolidation up here at the top of the overall range after experiencing a full look below and fail, making the full run up to the top of the balance in here, which is the intended target, but no aggressive pullback from the top of the range here does strike me as, number one, being bullish for the dollar, obviously, but number two, being a bearish relationship for equities. If the dollar breaks out here up and over 105.65, that's further downside pressure for equities in the lower pane. Let's take a look at the gold contract to see if this is supporting or sort of contradicting that thesis. And I would say it's sort of supporting, with the opportunity for a lower high in here, or even just the failure back down underneath this inflection point. Remember prior support turns to resistance, tried to turn it into resistance. We were above for a little bit. Now if it breaks down, again, lower gold here would speak to a higher dollar. We could also look at something like the SI for the silver contract, and although this pattern is not necessarily in force right this instant, it is worth being aware of, at least, that we have a big descending triangle here. If we flush these equal lows around 22.80, once again, that would put upward pressure on the dollar and thus downward pressure on equities in the lower pane below. Let's take a look at the 10-year interest rate, because of course today was an FOMC day. Let's see what we have going on over here. We'll talk from a Fed perspective in just a moment, but overall, pretty difficult to argue that we don't have a strong weekly uptrend at this point in time. I'm leaving it zoomed out so you can see that we are right at this inflection point for a breakout in the upward direction. As a matter of fact, on the Tuesday session, we did get a break and close up and over that 43.33. Now, on today's session, we pulled back a little bit, but we do have a lower wick suggesting that buyers are trying to step up here and continue to keep rates in the upward direction. Even if you just want to think of it, of course, as the inverse of the bond relationship, it doesn't really matter how you want to think of it, but but rates moving higher here seems to be like almost inevitable at this point in time, especially if we pair it with what Powell commented on in today's session. Let's take a quick look at our inverted ZTM in the wrong menu. Here we go. And this would also indicate basically what we're about to talk about from a Fed perspective, that, hey, another rate hike is still on the table into the end of this year. So we certainly didn't get the hike on today's session. The Fed opted for their pause, and you can see that there are ever so slightly higher odds now for a continued pause in the November timeframe. But if we go out to December, this is likely where the market's going to start pricing in the additional hike into the end of the year. It's the last month that they have to do it into the end of this year, and you can clearly see here the uptick in expectations for a hike, 550 to 575, although it still is underneath the expectations for a pause overall. If there is going to be the additional hike, it's likely going to be in the December timeframe. We can still see that the higher probability path is just prolonged, higher for longer, and clearly deeper into 2024, only expecting hikes in the back half at this point of 2024, which is totally in alignment with the new SEP that we got from the Fed on today's session. Here is the SEP Statement of Economic Projections, and what you'll notice, the biggest change is the median expectation for the Fed funds rate from the prior basically release, right? So from 4.6 to 5.1, and that's likely what the market's starting to reprice by seeing a move in the downward direction. If we're truly going to be at this higher for longer and we're not pricing in cuts to 4.6 in 2024, then guess what? It's very unlikely that equity prices should be where they're at, and maybe we'll see a little bit of coming in there. The other thing to really make note of is that we're still expecting a little bit of a hit to the labor market. Notice that, yes, this did technically get revised in the downward direction from 4.5 unemployment to 4.1 unemployment for 2024. However, the main takeaway is don't be surprised if we get bad unemployment data coming out and the Fed doesn't really flinch at it. They're basically expecting that, yes, this is the cost of getting price stability, which is their primary mandate, aka inflation, under control. The nice way to put it is, hey, we're just looking for a rebalancing of the jobs and labor market, as Jerome Powell put it so eloquently on today's session. So those are the primary things to be concerned with here. Once again, the biggest issue that I can see on this SEP is the revision higher for 2024 terminal rate there, 5.1 from a 4.6. I don't know exactly what the math would bring us to over in the S&P with that adjustment, but what we can talk about is that Jerome Powell was very explicit in today's press conference that, hey, this is not necessarily a trend. Right? In the beginning, remember, it was like 2 readings don't make a trend. Now we have 3 readings that are higher here. I suppose it's 1 and 2 that are now higher above what we got in the June meeting. However, you know, at what point is he going to say, okay, inflation is actually rebounding, it's time to do something about it? In today's session, he was like, we're sort of looking through, that's the term he used, we're looking through the volatility over in oil or energy prices at this point in time. It tends to swing up and down, and if it starts to make more of an impact on inflation, then we'll act. So he's still using the sort of back pocket situation of, hey, we're going to be data dependent at this point in time, which is kind of interesting to hear because this is going to give us a very clear metric as to whether or not, okay, where is the breaking point? Is it going to be when we get back to, 5% on the year over year, over 4.5%? Like, what is that breaking point where Jerome Powell says, all right, time to lay on the gas again and start, issuing more rate hikes? That will be a pretty big tell. A couple of other things that he said. At first, he fumbled on the soft landing comment. He said, maybe we don't see that as a base case scenario anymore. Then when someone asked a follow-up question on soft landing, he said, oh, yeah. It's still our intended, that's what we're looking to do. We're just not sure if there are going to be outside factors which would play a role in that. One last thing here, if we just flip back on over to the SEP, is the change in GDP here. We did get a revision in the upward direction for our GDP into the end of 2023 from 1% to 2.1%, and this is only going to be an issue if it causes inflation to move higher. But just remember that GDP is not a part of the Fed's dual mandate. So although, yes, it might imply that inflationary pressures are going to heat up, you can still have aggressive above-trend growth without re-accelerating inflation if you do it sort of, I don't want to say responsibly, but without maybe the lack of stimulus like we got in 2020. Wink, wink, nudge, nudge. So with that said, let's take a look at some more technical analysis. What about the market's appetite for risk on a day like today? You can clearly see an uptick out of the TLT ratio to the S&P. Let me zoom in on that actually a little bit more. So an uptick on today's session, but we have not broken that major resistance trend line that we just had on the chart. So no clear flight to safety yet in a major sense, although this could be the beginnings of a change in tone after basing out here for quite a little bit as the market has been going sideways, technically trying to produce a weekly lower high. So watching that quite closely. However, we're not all the way up and over the hump, so to speak, yet in the TLT ratio to the S&P. Let's take a look at short-dated bonds in relationship to one another because this would speak to confidence on the longer end of the curve, and currently the favor is for short duration. You can clearly see that because we're making, in this case, it's actually a higher high, but equal highs here are just consolidating high and tight in this overall range. Once again, that is not good from a risk appetite perspective. The only interesting thing that's going on here is that credit spreads are actually continuing to move in the right direction, primarily in the longer duration credit spreads here in the LQD, not necessarily the HYG. This is much more so sideways. I'm not concerned with this tangled up at the 50 SMA, but this is definitively lower over here in the credit spread look. So that to me would speak to a definitive stronger risk appetite for equities at this point in time, or like corporate grade debt, right? Instead of the government backed, which would be your IEF equivalent basically. So that's kind of interesting and would be a conflicting data point. But as of right now, I still think that there are more bearish data points than bullish data points that we've looked at. Here's the HYG in isolation. You can see the attempt at a higher low. So maybe a little bit of that dead cat bounce counter trend move we talked about in the S&P before making the rotation lower. If this does just snap the trend line, equal lows, lower low, you know the deal. It's probably just lower in the S&P to begin with. If this holds, again, look for that lower high bounce first out of equities. Let's take a look at the Bitcoin chart and see what's going on from that perspective. How's the digital gold doing amidst all of this volatility? And as we'll see in a second with the volatility, it's really not that bad. But Bitcoin is slightly higher, which kind of is interesting to me, once again, as a risk asset at this point, because it's certainly not a flight to safety. It's not a store of value. But as a risk asset, seeing this inside of the range and not continuing the breakdown is somewhat stacking up as a minor bullish data point. It's not like go out and buy the S&P because Bitcoin's holding, but you get the point, right? Overall risk appetite is a little bit more mixed than anything else. Some concerns on the longer end of the curve, longer end of the spectrum, but you can balance that out with credit spreads working out nicely, HYG higher low, and even something like Bitcoin staying inside of its overall range. What about market breadth? New highs versus lows has seen an uptick thus far on this week. However, we're still underneath the zero line, so it's pretty difficult to say that this is a bullish look out of market breadth thus far. Let's take a look at SPX A200R. This is making a move underneath the 50% mark, so once again, not bullish from a market breadth perspective. And we've actually got ourselves a brand new lower low in the SPX A50R on a daily time frame chart. So breadth seems to be deteriorating as the breakdown has taken place. There is no bullish divergence from that perspective, which once again stacks up more so in favor of the bears. Same thing going on here with the RSP, already producing an equal low. If I just zoom in, almost the rough equivalent to the S&P down below, this is where the RSP is trading, right? We're already at the equal low. If this breaks down, of course, that spells more trouble for weighted equities down below. Let's take a look at the Dow divergence because this continues to play out and once again stacks up as a bearish data point. You can see that transports are moving lower, whereas industrials continue to move sideways. So overall, the divergences, I would say here in market breadth, probably overshadow the neutral-ish risk appetite mixed bag that we just got from a risk perspective. What about VIX volatility? Closing out right at the 15 handle on today's session. So this is certainly not any type of capitulation type sell-off. This would not be a VIX marker as some sort of bottoming indication. As we know, we would need to be north of 2050 and really getting closer to that 40 handle in the VIX to say, yes, this is a capitulation style bottom. The selling has kind of come to fruition, right? As of right now, seeing this at the 15 might speak to the ability for the market to sustain actually some more downside pressure if we get more price acceptance over the 15 handle, kind of like what we got over here in the S&P. So watching that quite closely. And I think that this also pairs nicely with a VVIX, which is still remaining muted as well. It certainly saw an uptick on today's session, but we're not up and over that 103, which once again might speak to the ability for the market to sustain some downside pressure without necessarily coming into a capitulation, everybody sell everything type of panic move, which usually tends to mark some sort of low. So volatility actually might be a bearish indication with it being low and suppressed as the market is actually continuing to break down here. Let's take a look at volatility futures because these will tell the story of backwardation versus contango. And you can see that we're working our way a little bit of a new uptrend trying to build here with an inverted head and shoulders on the read, but still nowhere near the zero mark. So we're not really in a threat of backwardation here. 9 versus 30-day VIX is right at the zero line. So if anything, this is the closest threat. And one-day VIX did become elevated on today's session. Let's see if the market wants to build out some sort of trend like we had in the past? If so, that might be insightful as to how we might start to use the one-day VIX, but as of right now, as we know, this is really just more so of a one-off. Let's move along to the QQQ daily time frame chart. What do we see here from a trend perspective? Just like the S&P, we clearly have a daily lower high, and we flushed the equal low from the Friday close of last week, producing a bearish engulfer on today's session. We also had the Tuesday hammer candle, and it also represented the opportunity for a look below and fail on this as an overall range, and once again, that did fail on this morning's gap up. If we do continue in the downward direction, our next daily supports are coming in at 361, and then even lower than that is this pivot low at 355.25. It's probably fairly dim on your screen, but that is ultimately the number. On the daily time frame chart, once again, fairly difficult to become a new money short in the hole, as we say, at the bottom of the overall move. In a picture perfect world, you get some sort of lower high that retests 367 or a daily lower high up against the bottom of the overall range at 370. Let's take a look at our hourly time frame chart. That's a lot of hours. But what do we see over here? I think that there's a little bit more to read into from the morning's open on today's QQQ, because the gap is a little bit more pronounced up and over that zone here at 370 and sort of not just right to it like we got in the SPY. But notice that there's no attempt for a gap fill reversal. And as a matter of fact, all of the consolidation before the FOMC dump is underneath that 370. So there was a bearish indication here in the QQQ tech side of things ahead of the FOMC based on that sort of divergence from a structural perspective and more of a bearish tone being underneath the 370 bottom of the prior range from over here. So once again, the roadmap is fairly straightforward. Difficult to be a new money short dead on the lows here on the lower low. Remember, in a trend sequence, you never really want to short the lower low. You want to short a lower high or an equal low breakdown, right? ELBD as we call it. Over here on the channel. So these two are where you want to operate. You don't really want to operate over here. So being a new money short, risk reward is just not all that favorable. You're looking for a lower high that rejects the Tuesday low of day, 367. Entering here, stop here. Once again, your target would be back down there. So great risk reward from that perspective. If we do get some sort of higher low, you can scalp it long on a higher low over 367. But once again, what's the MO? You're just not overstaying your welcome, and you're changing your tone promptly on the back test of 370. If we do just get a straight shot lower, you might want to look for support down here. Will buyers step up at 361 to produce some sort of lower high, and that could be the intended outcome as we walk forward. Again, this short in here is not really favorable because we do not have a clean place to put our stop loss. It doesn't matter if the market continues to move lower if you don't have a place to define your risk. So watching that very closely around 361, just let the balloon, in this case, it's not going to be floating away, but let it pop, let it go down to the ground, and then we'll see if we can pick it up after a lower high is set here. That's making the most sense. Let's take a look at the VWAPs, the anchored VWAPs that is, and see if these are adding up with the thesis. Once again, underneath the entire cluster, your stronger daily lower high is a rejection of this anchored VWAP. That's all good from the 370 perspective. There's really no reason to flip bullish unless we get something that looks like this and starts to reclaim some of the anchored VWAP bands. So again, the stronger bull thesis at this point in time requires a higher low over 370, and nothing about the daily bar or even hourly structure here would be overly suggestive that that is a high probability outcome into the remainder of this week. If it happens, then we'll flip-flop back and forth with this market. That would just be something else at this point in time. We are sitting at the 61.8. Remember, on a relative basis, the S&P is already underneath the 61.8. The more price acceptance that we get underneath a 61.8, the higher the likelihood that we ultimately see a 100% retracement over time. So keep that in mind as well. That's from low to high. If we come from high to low, so if we could get a click, thank you, Thinkorswim. There we go, any day now. From high to low, looking at this move, again, 370, right on the money with our confluence for a rejection level. So everything's making sense there. Let's take a look at the market internals. Not much to really write home about over here. Same concepts as what we discussed over on the S&P. Pretty strong showing out of the gates here with the gap up, but completely failing, closing a cumulative build negative. This moves underneath the zero line, and we move underneath the zero line from a breadth perspective. Once again, the ratio on the day did deteriorate into the afternoon as well, even flipping bearish into the close, obviously, negative 2.15 to 1 on the Nasdaq here. If we take a look over at our market profile, it's the same thing with a spike. So value area is higher. It's elevated, as is the point of control. You can see a nice normal curve up here, but if you look at the spike, it did technically repair the poor low from the Tuesday session, which is a good thing, but the spike is definitely in place. So the same spike rules apply here as to what we discussed over on the ES. Your spike is the M period. So the top of the spike, to give you the number, is 15,219. Let's call that 15,220 for round numbers sake, 15,220, and the prior low of day day, or basically today's low of day, would be at 15,146. So if we're in between, we're neutral, we're looking for responsive trade here and here. Do we build out value in between? If we open underneath, remember that the market should auction lower to try to find more buyers at some lower price. We'll go back to the Thinkorswim charts and find you some support in just a second here. And if we open above the spike, then that means that these shorts are underwater on their trade. Expect some sort of a squeeze. And once again, what would the upper target be? Let's go back on over to the platform here. Let's maximize our, we want to look for, I just realized that this is the NYSE internals. We want to go to Nasdaq internals. It's still the same thing. So it's not going to change the analysis. Again, negative here, and negative into the cumulative build into the afternoon. But let's maximize that NQ and find a downside target together. So your stronger rejection is going to be off your prior low of day at 15,256. 15,256, right? 15,220 was the level that we were just looking at as a top of the spike. And if we do move lower, anything underneath 15,2 brings us all the way back down closer to 14. Can you imagine that? 14,950. 14,950 is your next structural target out of the NQ if we do get a gap and go, if we open underneath the spike and we need to auction lower looking for new buyers. And last but not least, we have the IWM on the daily time frame chart. This one is as clear as day. You can see that we've got ourselves our head and shoulders breakdown through the neckline. Tuesday was really the day that kicked things off. Wednesday after the FOMC, clearly we're closing weak at the lows and also threatening the break of an equal low support around 180 flat. If that happens, the only target that we really have before just chopping around in this range of oblivion, so to speak, is the gap close. Under 177.50 closes at 176.25. Obviously, that's a fairly large extension through the lower bound of this week's expected move, so I'm not forecasting that we need to look for any lower targets as of right now. We'll update you on Saturday, of course, if that does become a relevant issue. We've also failed to hold on to our daily 200 SMA that was baked in with the neckline of the head and shoulders, and overall this lack of participation from small caps and just the overall weakness, more pain over here as the breakdown unfolded, lack of follow through up to the equal highs as compared to the S&P and the Nasdaq side of things. It's really acted as somewhat the canary in the coal mine, so maybe we should start respecting IWM a little bit more from that perspective, its lack of follow through, its lack of respect for the overall market structure. So just something to be thinking about here as we continue to navigate the waters in the broad market as a whole. If we move on down to the hourly time frame chart, again, this really speaks for itself, breaking down from this as a range. Clearly, that's exactly where we fell off of from the FOMC announcement. So as long as we're under 183, it's very difficult to be a bull really across the entirety of the broad market with IWM and small caps acting as once again a canary in the coal mine. The only time that we really get more bullish, or at least neutral, I'm not even sure that I would be bullish on IWM and small caps, but if we can get some price acceptance back in this after a fake break of the daily pattern neckline, maybe that changes the tone. But again, how many fake outs can there ultimately be before, we need some type of direction? If it continues to be neutral on the higher time frames like the weekly, then we'll take it day by day as we've been doing. But definitively right now with the breakdown here on the daily, it speaks more so towards bearish odds as opposed to bullish odds for our broad market as a whole. We could do the same thing on our market internals. Again, nothing really to write home about. All of these really look the same with weak closes on today's session after a bullish start of the day. Same thing in the cumulative build. This is perhaps the nastiest cumulative build that we have over in the small caps. And if we jump on over to our market profile, can you already guess what it's going to be? Spike rules are in play. Just wanted to jump over here and give you the numbers. In the small caps, if we're over 1835.80, let's round that off to 1836. If we're opening over the top of the spike at 1836, looking for a squeeze of some of that action. If we open in the spike, looking for a responsive trade off of that and the low of day. Just to give you the number, the low of day is 1825.80, 1825.80. If we open underneath, again, auctioning lower, looking for lower supports. It's, at that point, just understand that the Russell is likely going to be drilling to the downside after our daily pattern breakdown. The other thing to point out here is that we were initially trying to get some value acceptance ahead of the FOMC inside of this liquidation break, a period from the Tuesday session, right? Tuesday was not at all similar to what we have over in the QQQ or the S&P basically. And we did get consolidation week at the lows, a weak close at the lows as well. And it looked like we were trying to reverse the curse, maybe hang on by a thread to that daily pattern. But with the FOMC nail in the coffin, it's very difficult to say that this value is going to hold up with the spike that's in play. If you've made it to this point in the show, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe if you've not already done so. Let's kick off the core list of companies here with Apple, definitely building out a lower balance area here and trading in the lower third of that balance area. If on the daily time frame chart we can sweep the 174 level, that certainly brings in some more sell side pressure. My first target would be the top of the gap at 170.50, noting that we already have a daily or even weekly lower high in place at this point in time. I'd really be looking for the breakdown of not only the 174 but through the 172.25 for this gap to start to come into sight as a potential target. That's the daily time frame chart. For all the scalpers, day traders out there, let's take a look at the hourly, build a little bit more of a granular game plan. Obviously, this as a double top is in force underneath the neckline. You can see the afternoon lower high underneath 177.85. As long as we're underneath that level, the bears are in control here, ultimately looking for the full rotation to the bottom end of the balance at 174, the daily level that we were just talking about. So if we do get a counter trend rotation, lower highs that stay there are looking pretty good. You could even say that this would be the picture perfect look underneath 176.50. The buyers only have something going on here if we can recapture with a higher low over the neckline of this most recent double top reversal pattern. Let's take a look at Netflix on a daily time frame chart. This continues to just sell and sell and sell and sell. So what are we doing? We're not chasing this on the lows. Remember, we need tight risk reward. I suppose if anything, there maybe was an entry today underneath the prior low of day after putting in and producing a green bodied bar, but closing weak on the lows like this after a more than 100% retracement just seems like a recipe for disaster to get hurt on any sort of retracement in the upward direction. So let's get a little bit more granular on the hourly and see what else we can learn. If you're a scalper, I suppose you could look for lower highs up against that 390.25 target, 383 on the downside. Next bigger lower target is your daily 200 SMA and horizontal level at 366.25. If we do get something that does this though, and we come back in for a inverted head and shoulders, that's where you really got to watch your back, especially on the short side over 400. We're looking for the retest of 415, and on the daily time frame chart, that makes total sense as a retest of your overall neckline. Remember that this is the prehistoric head and shoulders. It gave us a bunch of grief around the neckline originally. If we do get a stronger counter trend that once again builds out an hourly inverted head and shoulders, that would look something like this, over 400, backtest 415. So pretty cautious on the downside here, watching for a counter trend move over 400 if it wants to unfold in the first place. Next up, what's going on with Tesla, Mr. Musk, and the rocket ship over here? A lot of balance areas going on in some of the larger mega cap tech stuff that we're looking at here. So balance range in place. You can clearly see that upper wick rejecting up and over the midpoint at 268.50. So all eyes on the gap close underneath, and we have our daily 50 SMA at that gap closed level, 256.50. Anything beyond that is our inflection point from the midpoint of this prior range at 251. And this gets fairly tricky if we do fall into that range, because remember how vicious these swings were. It was full 100% retracement, 100% retracement, 100% retracement, right? Back and forth. Pretty vicious inside of that range. My primary idea would be if we could get some sort of gap fill reversal off of 256.50, that's where I would like to look for buyers stepping up over in Tesla. If we're underneath 256.50, I would be very cautious based on what we just walked through with those 100% retracements. Something that looks like this, right? So if this is your balance range overhead, something that goes gap fill reversal and then higher low over 260.65, that would be very bullish out of Tesla. I would look to trade that in the upward direction if we had participation from the broad market as a whole, which unfortunately seems to counteract or contradict the analysis that's been performed thus far on something like our S&P and Nasdaq. Let's take a look at the Google chart and see what's going on with Goog, because this breakdown is unfortunately becoming something that we need to pay attention to at the top of the prior range at 133.65. This is aggressive from the top all the way down to the bottom without any substantial moves in the upward direction for relief style rallies. So I would be watching 133.65 as a key level. If there's any sort of reversal pattern that gets put in down here, I think that you have fantastic risk reward in the upward direction to be looking for a buy side setup, tight risk, again, enter, stop, and then ultimately over time, looking for the rotation back up towards the top of the overall balance. Obviously, a big retest level is going to be where the breakdown came from at 136.75. So bears want to see bear flag consolidation, nothing impressive happen, and then a flush that gets you through your thin structure from off to the left. That would be 131.50 as a target. Bulls want to see something that does this, and then probably here to trade back up towards that 136.75. So from 135, or depending on if you could pick off this higher low as well, 133.65 up to 136.75 is the origin of this most recent breakdown. That's Google on our hourly. And here's the daily time frame chart just to provide a little bit more context. This is a buyer shut off pattern where clearly one engulfing bar is just wiping away all of the work of the prior 4, even 5 bars from this green body back here. So definitively more bearish than bullish, but looking for the opportunity and the stair steps to continue potentially around that 133.65. It's an uptrend until proven otherwise, and we are pulling back from the highest high in this sequence. Next up, Metaverse. What's going on over here? This one, not so much. You can clearly see your lower high here. Let's go down to an hourly time frame chart. This is the chop. This is the slop. This is the chart, the worst possible chart that we've been looking at over the past couple of weeks, really, with all the volatility and fake breaks, both on the upside and the downside. So play with your own discretion around here. I would just use 301 as a major line in the sand. If we're underneath 301, definitely more neutral or bearish. If we're above 301, neutral or bullish, but play at your own caution. I think that this is plenty of forecast or warning, shall we say, from Meta that it's not going to be the cleanest or easiest thing to navigate in this general vicinity. Next up is going to be NVIDIA. What's going on with NVDA? Here it is on the hourly time frame chart. We have not moved back to the daily. This is the hourly time frame chart, and you can clearly see the breakdown and price acceptance that we're getting underneath the prior overhead supply. As soon as we swept underneath that 445, you can see the lower high after the gap fill reversal, and it's been lower. NVIDIA has been a short for quite some time with the breakdown of this as an overhead supply, or even this as the original, right? There's your lower high, first push away through the equal lows. This was the professional gap down that we complained about the other day. But now that we have the lower high, this is definitively on the table as more so a short than anything else. Because we're coming into an equal low after short proximity of time, we've already tested it once. I would not be as afraid of NVIDIA producing a major upside reaction. Instead, I would say, okay, anything that remains underneath 432 at this point in time sets up the flush of that level at 419.25 to retarget 402.50. And if we just go to a daily time frame chart, there's a lot of history at 402.50 coming from the initial, remember this AI mania gap up stuff, right? There's that big inflection point, boom, right there, 402.50. So that would be the downside target. The only bullish look, and this is very, very clear and obvious on the daily time frame chart, of course, would be if we could get some sort of higher low backup over here over that 445 at a minimum. And it just certainly does not look like a feasible outcome given the daily bar and hourly structure that we were just looking at. Let's take a look at Microsoft. What's going on with Softy? Again, large bearish engulfer. This is obviously not in a balance. It's underneath all of this as overhead supply. It is, though, at a target here around 319.75 with a straight shot lower from a higher high. So this is one of those instances where I would say, okay, unlike NVIDIA, I probably would not be as apt to be looking for continuation in the downward direction, and instead, I'd be looking for the buyers to try to step up around this 319.75. If that is the case, a stronger retest would provide a short entry around this breakdown point, 326.75. If you can pick it off there, obviously tight risk reward, stop, entry, retarget the equal lows, if not continuation down towards that 312.50. Next up, last but not least, we've got the mini beast Amazon. What's going on over here? This is a daily time frame chart still, folks, daily time frame chart. We did not go hourly on Microsoft, but on the daily Amazon chart, we have a bearish engulfer. Notice that we looked over the hammer high ahead of the FOMC. So very similar to the gap up that was produced over in the S&P. It wasn't quite a gap up, but we did look over the hammer high. In theory, if that was going to initiate a bullish reversal, right, you would have wanted to get price acceptance above that and then battle for an intraday higher low over that 140. Simply was not the case. Obviously, everything is lower. We close week underneath the prior low of day and our daily 50 SMA. We are sitting on a trend line, so please keep in mind that you have something like that. If we do breach it, obviously you're just filling the triangle to your next equal low around 133.75. Let's go on down to the hourly on this one specifically because you can see that intraday rejection there off of 137.50. That should be edited. You guys know me. Cannot stand having those uneven numbers. So there we go with 50. As long as we're underneath that, bears remain in control here, looking for shorts up against it. That's obviously some sort of hourly lower high, right? So that keeps it in play. If we just get something that does this, it's kind of neutral. And once again, just like, what was it? I guess it was Microsoft, really, or NVIDIA. The higher low needs to be over 140 at this point in time if we're going to definitively be a little bit more bullish, right? There's just too much of a reversal that's been taking place here over on Amazon. Even if you want to think of it like this, as some sort of really skewed head and shoulders, your neckline is still around this area. You need higher low. You need to resolve this. We talked about the failed squeeze on the Monday session up and over that 141. So all things considered, definitely more of a bearish edge over here in Amazon. Let's move into 3 trade ideas and then you're on your way. First one is AMAT for Applied Materials. You can clearly see a daily balance area that's formed here with daily equal lows at 136.75 and weekly equal lows to act as your target much closer to 134 even. Obviously, it would help if the broad market continues to make a move in the downward direction tomorrow, but this is most likely going to act act as a day trade setup, looking for a breach of these lows, and then we will reevaluate at 134. If we take it on down to an hourly time frame chart, you can clearly see the descending triangle, the flush point that's building. If we sweep the 136.75 intraday, looking for a 5-minute lower high underneath and trading for that 134 equal low. If we do not breach underneath 136.75, or if we do not offer some sort of lower high entry on a retest, not as interested and certainly off the table if we produce a break of this resistance trendline, which would mean some sort of bar to bar higher high on the daily time frame chart. Let's move along and let's take a look at MU. Micron is the ticker over here. MU is the ticker, Micron's the name. But regardless, look at the upper wick from today's session. Big break up and over the double inside hammers that just completely failed to resolve a strong close at the highs, obviously thanks to FOMC, but an incredibly weak close all the way back down at this flush point. And looking left, we have incredibly thin structure underneath 69.40. If we start to break down there, obviously your daily 50 SMA becomes a first target, but the origin of the breakout around 66.10 is a little bit more attractive from a structural perspective. On the hourly time frame chart, once again, you can clearly see that upper wick, how it produces technically a higher high, suckering in new money buyers, right? And then to close weak at the lows, all of those buyers, I mean, this is a very, very visual level. You can only imagine how many stop losses are stacked underneath this. If we start to sweep it, we're probably going to stop all those traders out, initializing some sell side pressure, and once again, looking for downside as an outcome there. The best structural target, 66.10 as an outcome. Let's move along, and our last trade idea is on DIS. Feels like we've been beating this one up quite a bit recently, but it's just the nature of the chart. I mean, it's a hideous chart, really, really long-standing downtrend at this point in time. It flushed this key level. It offered a number of lower high attempts, and off of this lower high rejection, also a 50 SMA rejection, backtest of the breakdown point rejection, 85.35. What do we see? Certainly a 3-bar inside bearish play setting up into tomorrow's session. So bearish consolidation on today's session. It is ironic that this name closes green in the face of an FOMC sell-off, but nonetheless, if the broad market remains weak tomorrow, looking for a sweep of the equal lows at 81.90 for continuation into the equal low down here in the overall sequence down at 80 flat. Here it is on the hourly time frame chart. As long as we are underneath the 83.40 mark, that would have been a pre-market low on the gap down move from back here. As long as we're underneath that, the bears do have the upper hand looking at bearish consolidation. Once again, your break is through here to the equal low target 80 flat. That's going to do it for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving a simple thumbs up. We hope to see you in the pre-market prep, which is live every single day that the market's open, but tomorrow we'll be kicking things off as scheduled, 8:15. We'll see you there at the show. And with that said, everybody, I wish you a green trading week.